If you are counting on Social Security to carry you through 2027, there is a very real chance you could lock in a smaller check, trigger a higher Medicare bill, or expose your deposit to unnecessary risk before you even realize what happened. And that is the part most seniors are not being told clearly. Because the biggest 2027 Social Security danger is not one giant headline. It is not one dramatic announcement. It is a series of quiet decisions that can cost you hundreds of dollars a month, year after year, if you make them too early, too casually, or based on old assumptions. The money leaves first. The explanation comes later. And in some cases, the explanation never really comes at all unless you know exactly what to ask. So in this video, I want to walk you through the 2027 Social Security Roadmap in plain English. Not fear, not hype, just the key decisions, the hidden catches, and the protective moves that older Americans should be making now. Not next year, not someday, now. Because for many households, waiting is expensive. First, let's clear up one major misunderstanding right away. A lot of people hear the words Social Security crisis and assume that means benefits are suddenly going to collapse in 2027, so they might as well claim as soon as possible. That is not the right conclusion. Yes, the long-term financing issue is real. Yes, Washington has delayed dealing with it for too long. But if you rush into claiming based on panic, you can create your own permanent benefit cut, even if Congress does nothing at all. That is the first false assumption. Most people think, I should grab my Social Security early before the system changes. What that misses is this. An early claim is not a temporary adjustment. It is often a permanent reduction. The real issue is not just whether Social Security has long-term funding pressure. The real issue is whether you accidentally shrink your own monthly income for the rest of your life because you claimed it out of fear instead of strategy. Here is why 2027 matters so much. If you were born in 1960, your full retirement age is 67. That means 2027 is the year many Americans in that birth group hit full retirement age for the first time. And that matters because the gap between claiming at 62 and claiming at 67 is not small. It is not cosmetic. It is major. For someone born in 1960, claiming at 62 means receiving about 70% of the full retirement benefit. Not 90%, not a little less. About 70%. So let's make that real. If your full retirement age benefit is $2,400 a month, claiming at 62 would put you around $1,680 a month. That is a drop of $720 every month. That is $8,640 a year. And if you live on that benefit for 15 or 20 years, that decision can cost well into six figures over retirement. Not because Social Security cut you, because you cut yourself too early. And there is another side to this that very few people fully appreciate. If that same person waits beyond full retirement age, delayed retirement credits can continue increasing the benefit until age 70. So now compare all 3 points. At 62, maybe $1,680. At 67, $2,400. At 70, roughly $2,976. That is a completely different retirement income picture. This is why 2027 is not just a calendar year. It is a decision year. And in a moment, I'll show you the one-number comparison that can save some viewers from making the wrong claim this week. But first, there is a second assumption that causes just as much damage. Most people think Medicare costs in 2027 will depend on what they earn in 2027. What that misses is the 2-year look back. The real issue is that a tax move you made earlier can come back and raise your Medicare Part B and Part D premiums later. This is where seniors get blindsided. A one-time IRA withdrawal, a big capital gain, selling appreciated stock, converting too much to a Roth in 1 year, taking extra income after a spouse dies and filing status changes. Those moves can raise your modified adjusted gross income. Social Security uses tax return information from the IRS to determine whether you owe higher Medicare premiums under IRMAA, the income-related monthly adjustment amount. So the 2027 Medicare hit may be linked to an earlier tax year, not the year the bill arrives. That means the damage is often already baked in before the notice shows up. And the notice does not feel like a warning, it feels like a penalty after the fact. Now, the exact 2027 brackets will be set later, but the structure is already clear, and the lesson is clear right now. Retirement income decisions do not just affect taxes. They can also affect Medicare premiums. And here is the quiet mistake almost nobody notices. A lot of retirees think, it was only a one-year income spike. I'll just pay a little more tax. Not exactly. The problem is not just the tax. The problem is the chain reaction. Extra income can increase taxation of Social Security benefits. It can increase Medicare premiums later. And if you are living on a fixed income, that double hit shows up in your monthly cash flow right when you can least afford surprises. And remember, the tax thresholds for Social Security are old. Very old. Most people think Social Security is either taxable or not taxable in some simple way. What that misses is the formula. The real issue is that if your combined income gets above certain thresholds, part of your Social Security may be taxable, and up to 85% of benefits can become taxable depending on the numbers. For many seniors, that line gets crossed not because they became wealthy, but because they took one more withdrawal, worked one more part-time season, or had one more income event they did not realize would ripple through the system. So if 2027 is your planning horizon, do not look at Social Security in isolation. Look at Social Security, Medicare, and taxes together. That is how the system actually hits your wallet. Now let's move to the third dangerous assumption. Most people think if Social Security or the bank sees something wrong, the system will catch it before money disappears. What that misses is how fast the cash flow damage can happen. The real issue is not whether a problem can eventually be investigated. The real issue is whether your deposit is protected before the damage happens. This matters because benefit fraud and deposit change scams continue targeting older Americans, and it matters because the government itself has acknowledged that direct deposit fraud has been linked to people calling in bank changes by phone. So if your benefit is going into the wrong account, the money leaves first. The investigation starts after. That is not a small detail. That is a retirement survival detail. And it connects directly to 2027 because by then, many more seniors will be relying on digital account management while fraud pressure keeps rising. The protective move here is simple but incredibly important. Create your Social Security account if you have not already. Lock down access. Use strong authentication. Review your direct deposit information. Make sure the bank account on file is exactly the one you expect. And if you ever need to change direct deposit, treat that like a high-security transaction, not a casual errand. One quiet bank change can interrupt the money you use for groceries, prescriptions, utilities, and mortgage payments. Now let's talk about the fourth assumption, and this one shocks people when they finally see it. Most people think if Social Security ever overpays them, the agency will gently work it out over time and the monthly damage will be minor. What that misses is the withholding reality. The real issue is that if an overpayment notice arrives and you do not act quickly, a large chunk of your monthly benefit can be withheld, and for someone living month to month, that is a crisis. Imagine you receive $1,900 a month, then an overpayment notice comes. You assume it must be a mistake, but you set it aside because you are busy, confused, or waiting for someone to call you back. Then withholding begins. If 50% of that benefit is withheld, now you are down to $950. Same rent, same food bill, same insurance, same prescription costs, half the check. This is why delay is expensive, not because the letter is scary, because the cash flow interruption is real. And if you disagree with the overpayment amount, or you cannot afford repayment, the key is not to freeze. The key is to respond immediately. Appeal. Ask for a waiver if appropriate. Request a lower recovery arrangement if you qualify. But do not ignore the notice and hope it resolves itself. The system does not naturally protect silence. Now let me give you a realistic example that pulls all of this together. Let's say we have Linda and Ray. Linda is 66 in 2026 and turns 67 in 2027. Her full retirement age benefit is estimated at $2,400 a month. Ray is already on Medicare and receives Social Security. They have some savings, a traditional IRA, and a modest brokerage account. They are careful people, not reckless, not wealthy, just typical retirees trying to do things right. Linda hears constant talk about Social Security trouble and starts thinking she should claim immediately before something changes. At the same time, they sell investments and take a larger withdrawal than usual to help a grandchild and fix the roof. Then, a few months later, Ray gets a higher Medicare premium notice tied to income from an earlier return. Linda still has not claimed, but now she is leaning even harder toward claiming early because cash flow feels tighter. That is how these mistakes compound. If Linda claims at 62 level timing out of fear, she could lock herself near $1,680 instead of $2,400 at full retirement age. That is $720 less every month. If their earlier income decisions also push Medicare costs higher, that is another drain. If they do not realize a life-changing event can sometimes justify asking SSA to reduce IRMAA using Form SSA-44, they may overpay longer than necessary. And if they never review their Social Security account or earnings record, they may miss an error or miss a needed correction before benefits are finalized. Nothing in that story is extreme. That is exactly why it is dangerous. The losses come from ordinary households, making ordinary decisions without a roadmap. So what is the fix? The fix is not complicated, it is specific. First, if you are anywhere near claiming age, get your actual numbers side by side. Not your guess, not your friend's advice, your numbers. You want to compare your estimated benefit at 62, at full retirement age, and at 70. That one comparison can change everything. Because once you see the monthly difference in black and white, you stop talking in vague terms and start talking in real retirement math. Second, review your earnings record, not later. Now, if your earnings history is wrong, your future benefit can be wrong, and this is much easier to catch before the claiming process becomes urgent. Third, look back at your tax return and ask a very simple question. Could the income decisions I'm making now raise my Medicare costs later or make more of my Social Security taxable? If the answer is maybe, slow down before making another large withdrawal, sale, or conversion. Fourth, if your income has truly gone down because of retirement, death of a spouse, divorce, work reduction, or another qualifying life-changing event, ask Social Security whether you should file Form SSA-44 to request a lower IRMAA. Do not assume they will do that automatically. Fifth, secure the account where your benefit lands. If you do not have a Social Security account, create one. If you do, sign in and verify your banking details. Review your contact information. Treat that account like the control panel for your retirement income, because that is exactly what it is. And sixth, if you ever get an overpayment notice, do not put it in a pile. Call right away. Ask exactly why the overpayment happened. Ask what your options are. Ask whether you should appeal, request a waiver, or propose a repayment arrangement. The key is speed. 30 days can matter. There is one more group that needs to hear this before 2027. If you or your spouse worked in public service, education, local government, or another job with a pension not covered by Social Security, do not assume old WEP or GPO rules still apply the same way they used to. There have been important changes under the Social Security Fairness Act. For some people, that means they should verify their current benefit, confirm whether an adjustment should have happened, or even file if they never filed because they assumed they were blocked before. Again, do not rely on old assumptions. Old assumptions are expensive. So here is the final summary. The key danger is not a mysterious 2027 collapse that forces everyone to claim early. The key danger is making the wrong move before 2027 because you misunderstood how the rules actually work. The key misunderstanding is thinking Social Security is just one decision. It is not one decision. It is a timing decision, a tax decision, a Medicare decision, a fraud protection decision, and sometimes an overpayment response decision. And the key action is to get ahead of it now. This week, compare your age 62, full retirement age, and age 70 benefit estimates. Review your earnings record. Review your recent tax picture. Check whether a life-changing event could lower your IRMAA. Lock down your Social Security account. And if any notice arrives from SSA, especially about overpayment or Medicare premium adjustments, respond immediately instead of waiting. Don't panic. Preparation, not a rumor. Numbers, no delay. Action. If you do those things, you put yourself back in control of your 2027 income instead of letting the system make expensive decisions for you by default. And if this helps you, share this video with one person who is retired, close to retirement, or living on Social Security and Medicare right now, because too many seniors are losing money not from bad intentions, but from bad information. Subscribe if you want more clear, protective updates like this. This channel exists for one reason: to help older Americans avoid preventable financial loss before it happens.